Cool.
Okay, great. Hi, welcome back.
Yeah.
Round two.
Yes.
I thought this time we could talk a little bit more the investment side of things, as we seemed to talk a lot about first-time buyers stuff last time.
Yeah.
I thought I have a few questions about some investment and see what you've got for us.
Yeah, definitely.
Great. Okay, so I guess first things first. Why should someone look at in investing in property?
Well, I'm speaking out of my own experience, right? I guess, in having an investment property generates rent, and if it covers all the expenses associated with that investment property, it's what I call probably semi to passive income, right? What is semi passive income? Well, going to a job or working for a business actively, you're going there, spending your time, and after you spent your time or added value, you get a return on your money, right? So that's active income. Versus if you purchase an investment property, regardless if you're working or sick, not there, there's still a tenant that hopefully pays for your rent, all right, or on your property. And if it covers all the expenses, any left over is what we call passive income. So that's probably one of the major reasons that people want to invest in investment property. Secondly, I guess over time, and this is through some historical data, if we bought a property probably when I was born or 10 years ago or 20 years ago at a relatively good price, there's a thing called appreciation to the property. I mean, not all properties appreciate. This is not advice, but it's more like over time, through inflation and other factors, like your same house will be costing a lot more higher than what it was bought originally. So with that process, it's probably called capital growth. So that's another reason why people invested. In fact, Ben, last 2 years with the pandemic, people thought houses were going to go down or the other, go down in terms of value. But in fact, it's done the exact opposite, which has gone up in value. So we bought, let's say 2 years ago, a property at 500,000. It could go up in value. And let's say if we revalue it today or sold it in today's market at 650, the capital growth, if we were to sell it today, is 150,000 before taxes, of course. So that's another reason why people want to go into the market, for that capital appreciation. And thirdly, I guess they have options and choices. And just with that scenario, I just explained to you, if you made 150,000, you pay your taxes, and that would allow you to have a deposit for your next home potentially, or buy another investment property. So therefore, they're probably some of the major reasons why people go into investment property, Ben. Yeah.
Well, you nailed my next question then, was what are the benefits of having an investment property, but you've nailed that one already. Yes. So what are some of the drawbacks to investing?
Yes. So I think in terms of investment property, the risk associated is when you have rent, but there's a lot of costs in holding this property. So for example, it could be repair costs, it could be interest costs, right? And that's more than what the rent's generated. It's a technical term, accountants call it like negative gearing. But some people and in different circumstances would want that strategy, but it's costing you more to hold it, right? So that's one of the setbacks. Secondly, when you're buying a property, let's say the 500,000 that we used previously, if it goes down in value, right, after a few years or even a long period of time, it hasn't generated the capital growth that you wanted. So that's probably one of the drawbacks. And I think the third one, which I was looking for, was you don't have a tenant, right? You don't have someone renting your property, and it's costing you a lot to repair before it's in a rentable value. So without doing research, you're buying a property, the bathroom's going to leak, the kitchen, is something's not in shape. So tenants are not willing to pay that rent, and therefore it's costing you because there's still rates, water, expenses. So I think at the end of the day, we want to do that research and make sure that one is rentable, right? Secondly, is it covering my costs? And thirdly, is it in a good suburb that over a long time will go up in value and make a good return on your investment? Yeah.
Yeah, so well, I guess, and there's the unexpected again. I know we discussed it last time, but COVID as well. You know, people didn't have jobs, but then there was things put in place where the government, where landlords had no recourse to remove tenants who weren't paying, could they? So that would have been a big drain on a lot of people who relied on investment properties.
Yeah, and I guess, you know, as part of, you know, working with advisors or good mortgage brokers is making sure you do a budget and have a good buffer in place. There's another factor, which probably in the first one, you said the benefits. You know, we love investing in property, my own self, because, you know, I love this concept of OPM. And for those that are listening or watching, OPM stands for other people's money, right? So the bank's money. Which, you know, if the property value goes up in value and you have that borrowing capacity, allows you to extract that for a better use. Yes, you have to pay interest, but that can create some sort of buffer in investing in a portfolio of property spend. Yeah.
Yeah, great. So you've also just briefly touched on negative gearing. So I guess the next thing I would want to know is other than the drawbacks once you've actually invested, but what are the risks involved in investing?
Well, I think it comes back to, firstly, you know, what not knowing, right? You know, what you're buying. I mean, anyone can buy a real estate by going on realestate.com.au. Given yourself and myself can borrow from the banks, for example, it doesn't take much skill in terms of making an offer, right? So, for example, I mean, our office in Parramatta, like if you were, I mean, today's terms in 2022, right, a 2-bedroom unit when the market value is at 750, for example, and you go out there and buy at $1 million, I mean, any seller would want you to buy that property. But as a result, you probably overpaid for that price. So what does that come back to? It comes back to lack of research and not understanding what the market is, you know, accepting for a 2-bedroom unit in Parramatta, right? So that's number one. So you're overpaying for that particular asset. So that's probably one of the risks. Secondly, not doing enough research on the property in a rentable state. So it may look pretty nice as you on the pictures, right, in online these days. But they've done a renovation, so there could be a leaking, some sort of damage inside you're not aware of. So it's costing you more money to repair it. So initial capital. And lastly, I guess rent, you know, not enough rent to cover the associated costs. So cost means, you know, the interest rate, if you're borrowing to hold this property, the particular council rates, you know, in each state, because they may vary and cost a bit more in various states. Water rates, which, I mean, may not differ as much, but I think those costs, land tax will be another thing, like depending on circumstance, you need to speak to your accountant. That's an additional risk or costs associated in holding that property. But I think lastly is buying an asset. We mentioned if it's a Parramatta unit today at 750 goes down in value, there's not much of a return in investment. So these are the risks associated.
So I guess, as you said, mentioned with your account, but there should be a risk management plan. You know, we discussed it before, but your finances should be treated like a business. Yes. So before you make any business transaction, you put together a risk management plan, don't you? Yeah,
and I think having that clarity is power, right? People don't plan to fail, but they fail to plan. So I think as simple as having a discussion with your accountant, mortgage broker, a planner, a good one, to kind of, hey, this is what I'm doing based on my circumstance. Where am I at? Right. I think that's the first question. And secondly, where you like to go. And then I think third question is, can I do it? Right. Or, you know, they break it down into bite-sized pieces. Because they want to overshoot that. Hey, I want to get 10, but hey, let's start off with one investment property so we can work our, you know, ladder to 10. And 10 is a good number, but look, I mean, any number is a good number, but also another clarity on those. And I often ask my clients is, it's not how many properties you have, is, you know, how many properties are generating that positive a cash flow, right, that I mentioned, right? So a question I always ask, is it, positively geared, which is like bring money in, neutrally geared after neutrally geared, which is just, it sustains itself, or negatively geared, it's costing you money. Another question is before and after deduction. I mean, all these questions, some clients don't even know where to start. So therefore, I just can see which level they're at. They haven't gone to the depths of understanding the numbers or spoken with the accountant to maximize or minimize allowable deductions for the investment portfolio. Sorry, that's a lot of information, but
no, but I think it's useful, because I think the media paints a certain picture of investing. It's a no fail. You see these things on social media, invest. But if I suppose you only ever hear about the success stories through the media, you don't hear of the nightmares that have taken place.
Yeah, and I guess, there will be some learnings, including my investment journey. There are learnings as well. Like sometimes you don't sell, what you bought it, you sold it a bit of a loss. But I remember my first investment property, it was in the Melbourne area. Some of you guys may know, in St Kilda, but it was very negatively geared. It's costing cash flow, but negative gears on paper until you kind of sell it and realize a profit or cut your losses is actually, you kind of like made the wrong decision, if that's the case. So I agree with you, Ben. It is important to highlight that out of, investing, there are going to be some good choices and bangers, they call it, right, that you're going to be like, investing in, and some, not so much, right? So I think it's as long as you make more wins than you losers, and get some education along the way, right? Because people, like we said, you both can borrow, and we're just going to real estate and just, pick between eeny, money, mo. That's not the best way to invest, I guess.
Yeah, gut instinct's fine, but, a little bit of research to back it up doesn't hurt.
Yes.
So is there any, when we've been talking about rentals, using the property as a rental. Is there any benefits to just having it as a second home? I suppose obviously that's just another mortgage to pay if you don't have someone in the home. But is there any positive or negatives, other than dealing with problem tenants, between a rental and a second home?
Well, I guess let's start off with second home as a holiday home that you're going to be utilizing, right? So there's no rental, right? Well, I think firstly, you need to have your deposit, or depends on your situation, of course. But there's no rental coming through. So it's making sure that you or partners that you're investing in can service the mortgage. Then you can use it for your own use, right? So mainly, if that was the investment strategy, you're really betting on the capital appreciation in that particular holiday home suburb over a period of time, or your personal use. So I mean, in terms of passive income, it doesn't, because you're just going for holidays yourself, right? So I mean, if having a second home was a holiday home, and you are listing on Airbnb or with an agent generating income, I've seen clients that have done well from it, of course, and clients that haven't done well because they haven't rented out to enough tenants, right? So there's always two sides of the coin. Now, the only thing, if you're doing holiday rental, is just be mindful, speak with a really good mortgage broker that have done their research. Not all lenders will accept that, hey, if it's above market rental at 10%, that they will take that as a borrowing capacity or servicing income. So we just need to be very clear how much percentage that will be used, and that could jeopardize your borrowing capacity, right? So, or the LVR may change. LVR meaning the loan to value. They won't lend that at 80%, and could be slightly less depending on the lender. Lastly, you said if it's second home, like not for holiday, purely for rental, rented out to another family, then yes, that's kind of increasing your investment property portfolio. Not a short-term stay in terms of rental. It's a long-term, usually with a real estate agent, then that's the common practice, which lending-wise is more favorable, and lending's more favorable. It's just got all these different options. So I guess in answering your question, Ben, it's just knowing what you're going to be using it for, and is it going to get cash flow, or you're just purely investing for that capital growth. So again, going back to some of the earlier questions, to understand what's the strategy that you're going for in terms of investing in property.
Yeah, okay. No, that all makes sense. So we've talked about research, but what sort of research should we be going through before we invest? I understand that speaking to a mortgage broker and financial planner is great, but is there somewhere where we can go to look at market values, things like that that can help people make decisions?
Yeah, definitely. I guess when I kind of invested in all my years of investing, research is the key, right? Just like in real estate, location, right? That's one factor. In fact, I feel when I bought my investment property that I made money, I'm just that I use like Residex reports. What's Residex reports? So Residex looks at RP data or data that's property that's been selling, and then they kind of do some forecasts and say, hey, which suburbs are going to be increasing, right? So just as a guide, of course, gives you an idea what the median price, and then within that particular suburb or region, you can negotiate down further with a particular real estate agent, right? Secondly, I guess I kind of, through investing in Queensland, there's some reports like Urbis report. A common practice was PIE, P being population, right? So I guess any suburb that had no population and increase, of course, the real estate would go up in value. I for infrastructure in terms of the roads, schools and things that's going through, and lastly, employment, right? So am I close to employment hubs? Of course, pandemic has really shifted that need, because people are working from home, and you can see as a result, we're here in Sydney. What happened to the outer regions of Sydney? The prices have boomed, right? In the regional area, in places like Central Coast, Wollongong, or because as long as you have an internet, some employers allow you to work from home. So I guess the pandemic's given us, think in terms of going back, what are the reasons a property goes up? And I think that's probably where you should start with. And then in terms of real estate, is to negotiate hard with the agent. I always got taught by a mentor, you always make money when you buy, not when you sell, right? So, and not to zero, of course. If you're buying a property at zero, you probably made market value. So I feel that's an interesting skill or important skill to understand. So in terms of investing. So, but then the question is, do you have the time? So I guess in ZENRG, we don't provide that advice specifically, but we work with a group of experts, because we believe creating your wealth requires a group of trusted experts that's doing this all the time, right? So some are buyer's agent, some could be investment buyer's agent, right? Could be existing, could be brand new. It could be apartments, house and land, it could be existing properties. So I feel everyone is different. If I was to class everyone in kind of like, hey, this is what they should be doing, then we all be focused on that. But the reality is that we're all different, but we can always ask where you're at, where you want to go, and can I do it, right? They're the three questions.
That's right. No, look, that's fantastic. In fact, I might make sure that some of those things you just mentioned will pop in the description as well, so that people can have those resources to have a look at as well.
Yeah.
Might help people.
Yeah, there is a science to investing. If we're making more income, we're saving more money. The natural tendency is you would invest in either cash, real estate, or shares, right? So, in terms of science, once you have that 20% or you have equity in your home, you may not need any cash, right? So that's why it's talking to an expert to see where you're at, because I don't know what you study, Ben, like in university. What did you study? I'm just curious. Or
marketing and actually film production.
Right. So, you would be very expert at that, because you're doing that all the time. But, if I was to ask you marketing or film production, you probably have a list of steps. Just like, yes. Talking to an investor or mortgage broker, I've done it myself, right, many times. So it's more asking, hey, where should I start? So, and I think the reality is also like, hey, can I do it? Or if I can't do it, not to get disappointed, but hey, what's the gap and how do I get there? Because that's kind of like, you know, people get disappointed, oh, they can't do it now, but doesn't mean your income doesn't increase, doesn't mean you may not get more money in the future, right? So not now doesn't mean not later, Ben. Yeah.
Yeah. I suppose there's so many different variables, isn't there? It's just a matter of, and like I said, if the more you research, the more you understand it, the more you understand your own situation. I think that's important.
Yes, that's right. Yeah.
Yeah. Okay. So when we've mentioned deposit a few times now, is there any way to leverage, say, my current home or other investments as collateral for a new investment?
Yes, definitely. So this is kind of our strength, and what I've done with my portfolio to grow from, you know, single digit properties to, you know, double digits is what we say, OPM, other people's money. I mean, in terms of a nutshell, is more around people are focused on rate, like, and there's definitely, you can get cheap rates online with mortgage brokers and so forth. But when it comes to investing in equity, like in property, and especially the no money down strategy or using equity, is to get a valuation done, right, with a particular lender. Now, same property, different valuers, just like, you know, what's the color of your shirt, Ben? Like people will say, is it blue, is it gray, right? There's different opinions. Just like in the valuation of property, they use numbers, but, you know, it could be worth $1 million, 1.1, 1.2. But if you're purely going there because of the equity, where, you know, the lending is 80% of the valuation value, would you want to accept a lender that gives you a valuation, Ben, at $1 million or $1.2 million? Now, disregard the rate. Now, I mean, most rates are very similar, but let's assume rates are like, you know, very much the same, right? You know, what would you go for? I mean, simple answer is the 1.2, isn't it, Ben? Right? Yeah,
of course.
Because it would allow you more OPM given your borrowing capacity permits, which then allows you to leverage on a potentially higher property or more money for other use in terms of investment, shares, and so forth. So I think when people focus on the rate is important, but when it comes to investing, your equity or OPM is also important to kind of like, you know, leverage on additional properties. Just like if I was asking that question, Ben, if you had the chance 2 years ago, you know, how many, if we know this data is going up, how many property would you have invested if you had that chance again, Ben?
Yeah. Well, that's, yeah. I get where you're coming from.
So therefore, if you got an extra 100K to buy a property, it wasn't about the interest rate. It's probably about the mindset, the advice, the massive action, right? The mindset, right? Or the psychology as well, right? So all factors come into play when it comes to investing. So I hope that I've answered that question. Sorry.
No, yeah, you did. Sorry, just gave me a little bit to think about there for a second. Okay, so we've talked about that aspect, but what about using your super in order to buy an investment property? I'm not sure. I know Scott Morrison had some plans, but they seem to have gone by the wayside now. Yeah.
Well, I think definitely there's different structures, and probably a bit before that, Ben, the answer is yes, you can purchase in your SMSF. And I'll go into what are the factual, you know, minimum deposit requirements that you need. But I think usually when people go investing, they buy in their personal names, or if you're a bit more advanced, you know, tenants in common, which means a set percentage. You know, maybe the wife earning a different income, so different percentages assigned. Then they go into possibly in family trusts, right, which we do as well in terms of lending. And then lastly is the SMSF. So in answering your questions, yes. And the factual well, there's a myth, like a lot of people, including financial planners, may go, oh, well, yes, lenders don't do SMSF lending anymore. So we want to give it a bit of a myth bust. And the answer is no, they still lend, but not the major four banks, of course, but there's other lenders that will provide the funding. So the next question is, what do we need? For a residential property, you will need a 20% deposit as a minimum. So let's use numbers like 500K investment property. You'll need 100K, which is 20% of the property value, plus the associated stamp duty costs. Different states, different amounts, of course. But let's assume that it is 20,000, then you need 120,000, which is 20% plus stamp duty. Now, speak to your financial planner and accountant, mainly financial planner, because, is this the best thing for yourself? Because they may want to have you have some liquidity after buying. So, so you're not heavily just in one asset class, that you're more diversified. So meaning that after buying that $500,000 investment, probably you still have 50,000 cash in shares or other asset classes as a diversification. So lender-wise, they call it liquidity. Some lenders don't need that liquidity requirement. So simple answer, 20% plus stamp duty. For commercial, 30% plus stamp duty, which is in today's terms, 2022 in May, unless lenders change the policy, right? So that's where we stand.
Yeah. Let's see what happens over the next couple of months. You touch on
a bit on politics with obviously government changing hands. We're looking closely, and I'm sure with these podcasts and Zooms, we want to update how does that really affect you in terms of your mortgages, right? Definitely rates, if it goes up, it does affect your mortgage, but it could be certain policy that is for the current government could impact the way that you choose your investments. So that's why it's important to check in with us, not every single week, but I guess if we have quarterly or monthly updates, we want to keep you posted because that could impact your decisions.
Yeah, for sure. So we spoke about it. Is there a limit? I think you just briefly touched on that. Is there a limit to how much of your super you can use, simply because I know that that's sort of your fallback plan? So is it limited how much you can take out of that, so that you don't, if it all does go pear-shaped on you, you're not in a bad situation?
I think we need to understand a bit on the lending. Most of the lenders that provide this self-managed super fund lending is a non-recourse arrangement, which means if touch wood something happens, they're limited, like they can only recourse that particular property. And in that structure was probably in the US, and that's what sparked the GFC. Now, I'm not saying, hey, this is what's happening in there. It just means if something, tenants didn't pay and you couldn't repay it, right? Then they will just sell the property and recoup the costs, right? Or losses, right? Mm-hmm. But in your super, I guess you would have buffers, and even if there was no tenant, if you're working and there's some contributions into the super, then it allows to pay for the mortgage, of course, right? So that's why having a buffer, these are the conversations we need to have with the mortgage brokers or your advisors. It's not investing to the every dollar that you have or excess that you have. It's about having a backup. And this is like where, when I talk about psychology or your risk profile, then it's quite important which risk profile the financial planner will go to, like a bit more. So are you conservative? Are you aggressive, right? So regardless of conservative or aggressive, you still need to have some buffer, right? Because we want to cater for the worst scenario, right? So just like myself, if all my properties are not rented, I've got enough buffer for X that, would be, I can last for, but at the same time, I'll be going to my real estate agent. Why are these properties not rented out, or reduced rent, whatever strategy it may be, right? But I think when you're in that particular, investment, you would talk to people like us or other people to look at strategies that you can alleviate that risk, if that makes sense. If I'm saying there's no risk, that's you wouldn't be watching this. Everything there is risk.
No, well, that's why. What is it? Risk versus reward, isn't that the?
But I think it's to be in the game to win it. But at the same time, what I learned, it's not just in the game hastily. In the game, given you've asked yourself these sort of like thought-provoking questions or risk management questions, and then, hey, look, I kind of like are comfortable with that risk to go ahead. If you didn't invest, just like the pandemic 2 years ago, or let alone like 10 years, 5 years ago, like you would not have benefit from property investing because you're not in the game. Right? Yeah. So simple as that. So, but I think like if you're obviously leveraging a lot higher, there's certain risk versus if you're using more money and less of the lending, right? So the return and it will vice versa, right? So, but best, like what we're doing, speak to someone that knows what they're doing, because it's all good, like to go, hey, I want to do this, and I haven't spoken to enough people to compare or research, right? Then it doesn't move that plan forward, does it?
No, well, that's exactly right. Yeah. Okay. Yeah. Fantastic. Was there any other comments that you'd like to give, or any advice you'd like to give anyone out there listening who's thinking about investing at the moment, or someone who's planning on doing it in the future, that you'd like to share? It seems as you've now been doing it for not to give away your age, but for a little while now.
Yeah, definitely. Well, I guess definitely more than a decade, that's for sure. But I feel the key thing is having a budget is quite critical, like knowing what's going in and going out. No doubt your financial planner will ask you and your accountant. I think not 9 times, I shouldn't say. There's a lot of clients that come to and they want to invest, but they don't even have a budget in place, right? So they're not sure where they're at, which is a key question I will always ask. If you know the excess amount on a monthly, I mean, some people may not. I mean, if you were to ask me, hey, can I pull the numbers right now? No, I might need to go to some software or statements to really work it out. But once I worked it out, and monthly is kind of like as a minimum, but sometimes bills come out quarterly, right? So if you know your quarterly budget, right, what the excess cash you can invest in, it gives you a good idea, what you can do. But secondly, can I do it, right? Common clients come to us, they didn't know that they could do this, right? Because just like we talked about, your degree is in marketing, right? But you didn't study finance all this time, which we did for over a decade. So we would know, hey, Ben, with that deposit, you can, or people think you need a deposit. So at times, if you have a property already and a mortgage, there's some inbuilt equity. If that's a new term to you, then you should really talk to us, and so we can sit down and explain what that means and unlock that OPM. Then it can further your investment. When you do the invest, there may be risk. So it's again asking about, hey, what sort of risk? How does that apply to me? How can I manage it? Who are the experts that we should be talking to? And once you get your first investment under your belt, if it's bought correctly, some I've seen clients within 12 months that they built some equity that they can go again, right? I mean, that's the shortest time frame. I mean, there's one that take a bit longer, or over time, because you're paying down on your debt, you inbuilt, it's like a forced savings that you can, go again on that side. All right. So, I mean, I started young and I thought like, hey, man, it's, cash flow, is this all there is? And then over time, because held in there, right? It's like, you got to play this game in the long term, right? It's not just a short-term game. We all want to. I mean, we all sometimes buy shares or crypto and made money, lost money, but I feel real estate is one of those things that if you're going for that passive income, it's a long-term game, and we can kind of map that what it's going to look like in the future based on conservative numbers. Yeah.
And when you say conservative numbers, I guess a lot of people might be a lesson in patience as well. So you just mentioned crypto there, that bounces all over the place. For example, what just happened with Bitcoin. But something like property, you're never really going to lose too much. You've just got to not get disheartened and just push through.
Well, you're buying the time, Ben, because we don't know. The market can go up and down, and I mean, it's been going up, and for those that weren't in it, you just can't leverage on the growth. That's all. But if you were and you planned yourself like 5 years ago, you'll buy and you bought something. Of course, some of them are very happy that they experienced the growth. Some I have clients invested in the Southwest, like those prices in terms of house and land. Back then, you could buy, I don't know, it could be 600, 700. Now those prices are not like seen. Like is it possible? It can go back down to that price. Who knows? But what I'm saying, if you were to buy today, like you can't get those low prices anymore. It's just non-existent. Or even I shared not an article, just in the WhatsApp group in our company, like some of the properties in the north, like Epping, Eastwood, they were back then like in the 70s, 80s. I don't know the specs, but it was like 50,000 or something for a property. Now it's millions of dollars, right? So
Well, I'm living in the middle of the west, where the new Western train line is going to go out. And you had entire homes that were worth $1 million, $1.2 million. Now they're getting $1.2 million per acre.
Right. So I guess it's really understanding what is money, and then a bit of economics. Is like you need to have that basic knowledge, right? Credit, debit, right? What's the inflow, outflow, right? So these are the essentials, right? Because when we're reading those sort of reports, and especially when it comes to lending, hey, do you earn enough income? Can you repay the debt? Then the lender kind of ticks, there's some risks associated, no doubt, and we need to write a story. But you need to have these basic skills before we move forward, if that makes sense. Yeah.
No, that's fantastic.
Maybe my question to you, like, what did you get away from this? What are the key points from an interviewer, or like, what are the key takeaways?
Well, I guess just the understanding of the research side of things. It was an affirmation for me. I'm being in marketing and things like that. Everything is data, everything is information, everything needs to be attributed somewhere. And it's not just about that, the numbers went up. It's why did the numbers go up? What were the contributing factors? So it's sort of nice to know that skill set might be able to be applied to what I'm doing later on. Also, some of the technical side of things with, I understand when I first was a lot younger, I tried to use my super fund to buy an investment property and got turned down. But no one was really there to sort of explain why that had happened. And when I asked why, it was just, hey, we don't actually need to explain. See you later. So I was actually having little flashbacks there. That's why I sort of zoned out there for a minute, because I was having flashbacks of why. And you actually answered a few questions of why I got turned down back then. And it makes sense. So, that was actually sort of nice to get an answer 10 years after it happened. It's sort of why I got shot down. So yeah.
Well,
fantastic.
I think I think also not to different life stages. You and I talked about it, Ben, different. I mean, not using age as an example, because you may be very financially savvy already at a very young age, right? So different financial life stages require different financing needs or different levels of education. So what do I mean by that? First home buyer, I mean, not age focused, right? You can buy a first home at 18, could be 30s, 40s, who knows, right? But that financial literacy that you need to know, right, is very different to someone that's got, their first property and looking to invest in their second or first investment or second property, right? Versus someone that's 10 or different structures, or you mentioned in the SMSM, right? What's good in with us is that we know we cater with all these clients and really want to see where you're at, what your goals are, and then we can narrow it down and break it down. Hey, this is what you need to do first, A, B, C, and 1, 2, 3. Wait a bit, like you said, patience, just like our logo with the bonsai. You can't water too much, right? Just enough with a bonsai, otherwise you kill it, right? So it's giving the right financial nurture, and that's what we're about on that side. So sorry to kind of put a bit of spill, but I think it's really critical. I want to just highlight that point.
I think that's very interesting, especially in Australian culture. That sort of financial literacy, it isn't ingrained in society the way it probably should be. From a personal standpoint, I made some awful decisions when I was 18, 19 financially that up until recently still affected me. And that's because I had no real concept of what I was doing, and it was too easy to do certain things without realizing the repercussions of them. I think that's something, and this is hopefully why I like the idea of doing what we're doing here, is because we're trying making some of this information more accessible to people. More people can search something and get the answer that they want without having to read through government documents or even feeling embarrassed and having to go ask someone. Someone can sit here and look for what they need and get an answer, and maybe come to you with any further questions that they might have.
Yeah, and just Ben, I know we're going longer than usual. It's like one of the mentors that I've learned from, I call him Uncle Tony, right? But Mr. Robbins, he always says success, let's just say in property investing, is a result of good judgment, right? He always says good judgment is a result of experience, right? But what's experience? And experience is often a result of bad judgment. And the reason why I link it to this kind of podcast or the interview is that we're not sugarcoating things. There are risks involved. What are the potential risks that can go wrong? And you're educated on that, but also strategies to eliminate, reduce that. But then also like the media will talk about the upside, right? Or the most scary thing as well. So let's just put things into perspective. So, viewers or clients of ours are educated on what they need to do based on their circumstance. Yeah.
Yeah, and I think that's fantastic. I think there's a big difference between holding someone's hand and walking them through it, but also educating them, so that they understand why certain things are happening.
Yeah,
I think that's far more important than just doing something for someone.
Yeah, it's an hour. We will spend more time as we go along. I think that's the key thing. Yeah,
I think it is. Yeah, Alan, thank you very much for today. We will be back next month with another one, and we'll have this up nice and soon for everyone out there.
Okay, thanks, Ben. Appreciate your help. Okay,
thanks. Bye.